let's take a look at this rally right here. Right, that's the one we're enjoying right now. That's about 11.5% right now. It looks in many respects very similar to this one right here that happened in late September into early November. So the key here is this is about 12%, same as here, about 11.6%. And the question is, are we in for something like this again? So it looks as if this distance above the 50-day average means the market's kind of overbought. It's kind of getting ahead of itself a little bit. And do we actually have the oomph to get us out of this range? By the way, this was a box that we lived in for months last year. And obviously, we're dealing with a much wider range right now. So I think a lot of people, even bullish folks, want to see this curl down a little bit and have this catch up. And maybe it's a better entry point just to see if it's as fragile as it was right here. Because this was November, December choppy, and then we lost all those gains.
Which is just interesting fundamentally because December we got that first interest rate increase from the Federal Reserve in almost a decade. Here we are again, this leg higher by this idea that they're not going to raise rates so quickly here.
Exactly. So that's what's creating, I think, the sense of comfort out there that maybe the Fed is not going to be hostile to this move. What is interesting, though, is the difference in sentiment. I would perceive right here, when we were about to top out in early November, I think everybody was essentially saying, look, we get a year-end rally ahead of us. The seasonals are in our favor. Santa Claus isn't far away. And you never really got that rally. Whereas over here, I think, where we are right now, I think there's still some measured skepticism about this move. Yes, in the short term, we have to pull back. The big question is, can we absorb a pullback in oil? Can all these things work together and not have this rally completely evaporate?
So let's look at the S&P, because the Dow has had a little bit more strength, maybe because of the weakening dollar, a lot of multinationals in the Dow. What does this one look like?
And as a matter of fact, the Dow actually went to a lower low, as you see over here. So we actually had a worse experience in January, February this year with the S&P than we did with the Dow. The very conservative stocks in the Dow are helping it out, but it's really the same story. This is about an 8% gap between where the S&P is right now and where that 50-day average is. And that, some people are saying, shows you that just it's running a little bit hot. It doesn't mean it has to fail right here, but it seems as if you really do need to have the real buyers come in, maybe have that pullback, see how the market digests.
Getting a little overbought. And in terms of fundamental catalysts going forward, coming up on another
earnings. You got to hope on earnings. Yeah. Honestly, that has to be the piece of it, because a lot of times we've gotten these rallies when you had fear evaporate very quickly, and then you had well, let's see what's been fixed. Valuations haven't really been fixed necessarily. It's about the same valuation. The yen is still rallying, you might have heard.
Yes,
that usually isn't great for risk assets. So a lot of these things, I think, have to be sorted out, at least psychologically, before we get to earnings.
It is really all one trade. I mean, you have this weakening dollar, which is providing relief. You have the price of oil above 40, which we could do a technical chart on that alone. Emerging markets are rallying. Even the Chinese currency has been rallying.
Exactly all the same trade. And honestly, I think if you're bullish on stocks, if you're discovering the bull case on stocks right now after this 12% rally, you have to look at oil where it is right now and how far it's come, 32% in a month, and say, would I buy that chart? Because if you wouldn't buy oil right here, I'm not sure you want to get too aggressive about buying the S&P. Yeah, without a doubt.
Michael, thank you.
Right,
Playing technical analyst for us today, our chief markets commentator, Mike Santoli.